Hi everyone, and a very warm welcome. Thanks, darling. And hopefully you can see my screen, and hopefully you can hear me as well. Um, if Anna could let me know if she can hear me, that would be great. Oh, wonderful. I've got several workspaces set up and pick up some of the things Anna was talking about. This is the starting point. We're on Ninjatrader here, and this is a classical arrangement. We're on futures, and what I've got here on the top line, I've got the YM, the Russell, the ES, and the NQ, and I've got those on 1 minute. And then below, I've got the micro contracts because I just wanted to show you, I've shown this before, but just to reinforce the point that the micro futures are, if you've not traded index futures and perhaps it's something you're tempted to try or as an alternative to the ETF market, then these are available. They are a tenth the size, and it's really just to show you that several things, in fact. First of all, how liquid they are. And you can see from the price action that they are immensely liquid. It's not spotty, the price action. It's very fluid, and the VPA works in precisely the same way. But the primary reason for having the four indices is to get a sense of whether we're seeing any divergence, whether we're seeing one index outperform another, whether we are seeing one index go in a different direction to the others. And broadly speaking, you can see across this time horizon, certainly on the top line, that they are all pretty much doing the same thing. And the other reason for having this arrangement as well is to get a sense of, from a technical perspective, where are we at? And you can see the only indicator I've got loaded on the chart here is the VPOC. And you can see on the top line on 1 minute, they are all pretty much oscillating around the yellow dashed line, which is the fulcrum of the market. So it tells us, first of all, that the four primary indices, if you like, are in agreement, broadly speaking. And secondly, certainly on this time frame, they are not going anywhere soon, in inverted commas, on a 1 minute time horizon. Drop down onto the 5, onto the micros. And really, I guess what stands out there is the fact that the ES, I'll just pop that up full size. I always go down to the right because I'm on trading view all the time. Pop that up full size. There we are. So as far as the ES is concerned on the 5 minute time horizon, is that going anywhere? Not at the moment, because we're trading around the volume point of control. But the others are not. If we go down over on the left-hand side to the YM, as you can see, just move the chat box out of the way. That's got a little way to travel before it gets to a potential congestion phase. And this is what you always need to know, because there's one thing you can guarantee about the price when it approaches this region: it is not going to move through there rapidly. And it doesn't matter whether we're looking at a future, whether we're looking at a stock, whether we're looking at an ETF, commodities, whatever it is, it doesn't matter whether we're in Forex. It works in exactly the same way. So if the price action approaches this region, you can be assured that certainly one thing will happen, and that's congestion to follow. And the reason that occurs is because volume works in precisely the same way as it does in terms of price-based support and resistance. Anna was talking about the accumulation distribution indicator and levels. We use the VPOC in the same way in terms of levels. Now, the other aspect to it is the histogram here, and you can see we've got a relatively low volume region here where price didn't stay there very long. It came through there very quickly, as you can see on the left-hand side in the down trip. And now we're coming back up to retest it again, if you like. And all things being equal, the price should move through there fairly rapidly before it starts to pause here. Now, if we had a much wider area here, that's good news. If we're trading to the upside, we're bullish on this instrument, whatever it may be, because it gives us another piece of the puzzle from an indicator perspective. And of course, we'd be looking at it from a volume perspective down at the bottom here. But it just gives us another piece of the puzzle to plug in, to give us a view on what is likely to happen as the price approaches that region and on up into the VPOC itself. Finally, just one other aspect to having these four indicators, or four indices up rather. The three of them, I guess, you can group as equal in terms of importance, if you like. Let's put it like that. And I'm talking about the YM, the NQ, and the ES. So they are, if you like, heavyweights in the industry, heavyweights in the market, and the ones that everyone tracks and views. The Russell, which is the one here, the RTY and the M2K below it, the Russell is a much higher risk proposition in terms of risk because the spread of companies that it covers are higher risk per se because they are smaller. There are a lot of growth companies in there. And therefore, by virtue of that fact, it's always interesting to view the Russell against those three, in inverted commas, heavyweight indices, if you like, because what it tells you is that if all four are moving en masse, either up or down, then the broad sentiment is across the entire market. But on occasion, what you will see is you will see the three heavyweights moving higher, but the Russell is not following suit. It's moving in the opposite direction or it's stagnant. And what that reveals, if you like, is that yes, there may be risk on sentiment as far as the major indices are concerned and the major handful of stocks that constitute the momentum in those indices. But underneath that, the Russell as the 2000 or the 3000, the sentiment towards those sorts of stocks is weaker. And therefore, it's always useful to look at these four in that context, to consider the Russell as what we call a risk indicator index, if you like, a double risk, if you will. So you've got risk of equities, but then on the Russell, on the smaller companies, you've got double the risk, if you like. So it's always useful to consider it in that context. But I wanted to show you that workspace, really just to show you the fluidity, to get you to think about looking at them across the four of them, and also to bring in this view on the Russell, how to view that as a double risk, if you will. Just drop down onto another workspace here. Let's go to the VWAP first. This is on Apple, and as Anna said, you can see over here, I've got the 30-minute, probably pop that up full size, easiest way to look at it. There we go. I think on the heat map Anna pulled up, I think it had a 4% fall across the day. And this is our VWAP indicator, which is not yet rolled out, but it will be rolling out. And it's a 5-in-1 indicator. So let's just drop that back down there. In fact, no, let's leave that up. It's easier to show you full size. There we go. This is a 5-in-1 indicator, and if you're not familiar with what the VWAP is, it's the volume weighted average price. So it's very much centered around volume and how that relates and how that, what's the word I'm looking for? How that, can't think of the word, how it relates to the price action. And typically what you see here is the VWAP in the center line, and then you've got the outer envelopes, that was, as we refer to them, which are one standard deviation. Now, the traditional way of using the VWAP, as you can see here, in these pinch points, the indicator resets and it starts again at the new trading session. And that is typically the way it works. But what we've actually done in developing the indicator, I just click on the indicators here and we go onto the VWAP. We have actually included 5 variants of the volume weighted average price. And why is it so important? It's important because the VWAP indicator is one that is used a great deal by the institutional investors, where we are dealing with large blocks of stock, and where it is very much viewed as the VWAP is the price, a fair market price. You can think of it in very similar terms to the VPOC we've just been talking about, where the yellow dashed line is one where price is in agreement. And what the VWAP is trying to communicate, and certainly it's muted that around 40% of institutional orders are based on VWAP, because VWAP is considered a fair market price. And therefore, it makes sense for us to follow the VWAP and how it varies throughout the trading session, whether the price is above or below, because what the algorithms are trying to attack is to get the best price, is to buy below and to sell above. So if you've got this huge weight of institutional orders out there tracking the VWAP, it makes sense for us to track it as well. And in a very similar way, it's the reason we apply volume price analysis, because we are tracking the market makers, and using the VWAP, we are tracking the institutional buyers and sellers and the order processes through the day. So there are 5 variants that we've developed, which come as in the one indicator. You select which one you want. There's the traditional VWAP, which is the one we're looking at here, where the indicator is, as I say, resets automatically at the start of the new trading session. The next one is the moving VWAP, which essentially continues the VWAP across the sessions. So where you have a moving volume weighted average price, you do not get these pinch points. What you would see is a continual flow of the VWAP across the sessions. The algorithm just continues calculating irrespective of the session crossovers. And the reason I like it is because it makes this area around here much clearer. If you're on a faster time frame chart, then this area can become a little bit congested, a little bit messy. It's quite hard to see where the price action sits, whether it's above, below, how far above and below, and where it's sitting in the context of the envelopes above and below. So the moving volume weighted average price moves straight through and gives you a much, much clearer view. It's the one I prefer, but that's my preferred. The third one here, the AVWAP, is an anchored VWAP. This allows you to drop the start of the algorithm anywhere you choose. So you can be on any time frame up to, but not including the daily, because that's covered by the 5th one here, which we'll come on to in a moment. But essentially what you can do is drop that anchor anywhere. So here you're looking for key highs and lows. You're looking for those important areas of price. It's a little bit like you might use a Fibonacci, for example. You might go to a significant high and start there, or a significant low, and they can be fundamental based, they might be volume based, technical based, whatever. And you just drop the anchored VWAP on it and off you go, and it starts the calculation immediately. So that's the third variant. The fourth variant is the one which doesn't have volume. It is a time weighted average price, and that will average out time. Again, very popular. And finally, down at the bottom here, we have the intraday VWAP, which gives you the opportunity to apply this to the dailies, the weeklies, and the monthlies. So it's much more of a longer term investment tool in that scenario. So as always, not only have we expanded what you will get in the indicator, but we've also enhanced it. We've put the standard deviations on here as well. You can manipulate them as you wish. You have options. These are set to default at 1, but of course you can vary them accordingly as to your own personal preferences. So I wanted just to show you that. But what's interesting about the VWAP, if I just pop open this one, which is the 10-minute, there we go. What you will see a lot and occurring often is this revisiting of the VWAP, which you see here. The price comes back, it finds the level, and off it goes again. It starts here, it's pushed down. And what the VWAP itself does is to apply that pressure when we're below the VWAP. A lot of traders using VWAP will use the VWAP itself as a trigger, if you like. In other words, above the VWAP we buy and below the VWAP we sell. We've recorded a lot of videos to explain. I'm not going to go into it now, but we use a much more sophisticated approach, which we think gives a much, much better return. And of course, as you would imagine, it's also combined heavily with volume price analysis. And that's probably the major difference. If mechanical traders appreciated the VPA methodology, then they would be much more successful than simply using it as a very mechanical, almost an EA, if you like, above, buy, below, sell. It's far more sophisticated than that, I can assure you, and applying volume price analysis with it is just a great combination to use to look at opportunities for getting in, to staying in, and also for getting out. Let me hop on to another workspace, which is another indicator. With all of these indicators will be rolling out with the stock trading and investing program. Let's just move the control panel out of the way. The workspace here, I'm on Tesla. I'm on 1, 3, and 5 minute. Tesla, bless its cotton socks, always delivers something. If you're an intraday trader, you can be. If Tesla is quiet, then the rest of the market must be absolutely dead. Simple as that. This is 135, and I've got the what we call the volume relative strength indicator below on the top line, and the line below of 3 charts, the 1, the 3, and the 5, are simply with our volume price analysis methodology, no other indicators, because the important thing with any indicator we use is we always use it in combination with VPA. We don't use it in isolation. Indicators are there. We often get asked this question. Indicators are there to support our methodology. And this is another volume-based indicator. It's volume relative strength. So it's looking at volume through the relative nature of volume. And in doing so, it tries to give us a view on the pressure associated with any move. Now, if I pop open one of these, let's go up to the 5 minute here. It does that in several different ways, and there are essentially 3 primary components to the indicator that we always look at. The first is obvious, which is the crossover point from bearish to bullish in this case. The second component is the color component. The darker color here is signaling very bearish sentiment or very bullish sentiment. So again, it's a color combination where we have, in this case, we've got darker colors signaling strength, and the weaker colors, the knockback colors, are signaling a diminishing of that strength. And you've got the same over here on the bullish side. The third element to it is the height of the pressure bars, as we refer to them. And in a way, this mimics and mirrors what we look at constantly in terms of volume price analysis, which is not only the height of volume bars, but also their relationship to one another. Are they rising generally? Are they falling generally? So the analytical principles that we use for VPA are identical here when combined with the VRSI indicator. And what we see is exactly that. We are seeing not only a shift in color here to the bearish side, clearly darker color. So we know for a fact we're in bearish territory because we're below the fulcrum line anyway of 0. But much more importantly is the height of these bars. And it's increasing as we move down. And yes, as we get these little pause points, these little pause backs, of course we get a shift in sentiment here, a little bit of a diminishing of that bearish sentiment. But what's key about it is that the height of these bars is not falling away as it does here. These only start to fall away once we see the trend start to weaken, the strength of that trend. So what you're witnessing here is really a visual graphic of the strength of the trend. And it's self-evident, but what I'm going to say, but the steepness of any trend, whether it's the downside or the upside, will be graphically represented by the height of these bars. And of course, all of this is underpinned by what is going on in terms of our volume profiles on our volume price analysis methodology. Bear charts, or whether we've got other indicators on there, we'd have accumulation distribution, volume point of control, we'd probably have a trend monitor on there, and so on and so forth. And when you move over to the right-hand side of the chart, what the rest of the price action and what the rest of the VRSI action here tells you is that this is a relatively weak rally. purely by virtue of the fact, yes, we've moved into bullish territory here, but look at the size of these pressure bars. They are tiny. This is crawling higher. This is not rushing up. It's just crawling. We get a little reversal here. We get a short-term punctuation into bearish. But note the highest of those pressure bars, it's not terribly strong. So in that case, it's telling us that this is not going to revert to something like this. It's merely one of those pause points where we're seeing maybe selling, whatever reason. Yes, we've got widening candles, but the pressure there reduces very, very rapidly. First of all, as a result of a shifting color, and secondly, the height of these is tiny. And it all goes back to comparing it to what went on over here. We then move into a bullish phase. We get an injection of volume here. We get a widespread candle, and that would probably be associated with good volume. But even that is not sufficient to really say, okay, this is going to be a very strong trend reversal. It's just, again, gone into this flat line here, which with the height of these pressure bars really diminishing steadily as the market comes off, and then we just go into this very quiet phase of price action, just oscillating back and forth, really going nowhere. And that stock, that index, whatever it is, that future, that ETF is really not going to move very much until we see an injection of volume, which will be reflected automatically in an injection of pressure. And the beauty of it is, as I say, is really the way that we analyze it is exactly the same way as we do with volume. So it really doesn't alter the way we look at charts. It's just a different way. Excuse me a moment. Just going to switch off for a minute. Sorry, I had a frog in my throat. It really doesn't alter the way we view anything or interpret it, indeed. It's precisely the same. Now, clearly, it's very quiet at the moment because we're coming to the end of the session, which is what you expect to see. I'm just going to hop over onto TradingView because I've got several workspaces here and I appreciate the time.